Let me tell you something that most people, including the so-called experts on television, fundamentally do not understand. The stock market is not going to crash the way you think it is. And if you're sitting there waiting for it, if you've been waiting for it, you may be one of the most dangerous kinds of investors alive, not because you're dumb, but because you're almost right. And being almost right in markets is far more lethal than being completely wrong. I've been doing this for over 50 years. I've watched empires rise. I've watched empires fall. I studied every debt cycle going back to the Dutch Empire in the 1600s. And what I can tell you with a level of certainty that should terrify you is this. The stock market doesn't crash when people expect it to. It crashes when they stop expecting it. Right now, everyone is expecting it. Everyone is watching the Fed. Everyone is watching interest rates. Everyone is watching inflation data, watching earnings, watching geopolitical tension. You know what that means? It means the market has already priced in the fear. The anxiety is already baked into every trade, every hedge, every conversation, at every dinner table in America. When fear is that widespread, the market doesn't collapse. It floats, it frustrates, it grinds upward in ways that make your stomach turn. Here's the first thing I need you to understand. Markets are driven by credit, not by logic. Think of the economy as a machine, a beautiful, intricate, almost living machine. And inside that machine, the most powerful fuel is not innovation. It's not productivity. It's not even corporate profit. It is a credit, the simple, extraordinary ability of one person or institution to promise another that they will pay them back in the future. When credit expands, everything goes up. Stocks go up, real estate goes up, art goes up, crypto goes up. When credit contracts, when that promise of repayment suddenly looks shaky, everything comes down fast, sometimes violently, sometimes in ways nobody saw coming. Now here's where it gets shocking. The Federal Reserve, the most powerful financial institution on earth, does not want a stock market crash. Not because they love you, not because they love your 401k, but because a stock market crash is a political catastrophe. It is an employment catastrophe. It is a banking catastrophe. And in a world where the U.S. government is running deficits that would have been unthinkable 20 years ago, a market crash would make the cost of financing that debt spiral to levels that become genuinely unmanageable. So what do? They print, they adjust, they cut, they intervene not with the press release, but with the quiet, powerful movement of capital through the system. Trillions of dollars repositioned in ways the average investor cannot see and cannot track. This is not a conspiracy theory. This is a structural reality of the modern financial system. And if you don't understand it, if you're still thinking about the market through the lens of price-to-earnings ratios and technical chart patterns, you are respectfully playing checkers in a chess tournament. Let me give you the clearest picture I can. We are living inside what I call a long-term debt cycle, a period that repeats roughly every 50 to 100 years in economic history. Right now, we are in the late stages of that cycle. Debt levels at the sovereign level are at historic highs. The gap between the wealthy and the poor is at levels not seen since the 1930s. Political tension is rising. International order is shifting. Every single one of those signals historically precedes a very significant reorganization of the global financial system. But here is what history also shows. And this is what almost nobody is willing to say out loud. Before the reorganization comes the melt up. Before the great collapses of history, markets have a final surge, a final irrational, breathtaking run upward. It happened before 1929. It happened before 2000. It is a feature of the cycle, not a bug. It is what happens when liquidity is abundant, when the alternatives to stocks look unattractive, and when momentum drives behavior more than fundamentals do. And the people who get off the train too early, who sold their positions waiting for the crash, they miss it. And then they buy back in at the top, chasing performance, right before the floor disappears. That is the trap, and most of you are walking directly into it. I want you to do something for me right now. I want you to forget everything you've been told about how markets are supposed to work. Forget the textbooks, forget the financial media, forget the idea that markets are rational, self-correcting mechanisms that punish excess and reward discipline. That model, that clean, academic, beautiful model is fiction. And I say that as someone who spent decades building one of the most sophisticated quantitative investment systems in the world. The real market, the market that actually exists, is a political instrument. It is a thermometer for confidence, for power, and for the flow of credit. And right now, the entities that control that flow have made a decision, not in a single boardroom, not in a single meeting, but through the collective weight of their incentives. And that decision is simple. The market cannot be allowed to fall too far for too long. Let me explain to you exactly how this works, because the mechanism is more elegant and more alarming than most people realize. Start with sovereign wealth funds. There are now over $12 trillion in sovereign wealth fund assets globally. Norway, Saudi Arabia, Abu Dhabi, Singapore, China. These entities are not day traders. They are not chasing quarterly earnings. They are permanent capital, and they are systematically allocated to global equities. When markets dip, they buy, not because they're optimistic, because it's their mandate, because the alternative holding cash that loses value to inflation is worse. Now layer on top of that the corporate buyback machine. In the last decade, American corporations have spent more money buying back their own shares than they have spent on capital investment, research, or worker wages combined. Think about what that means. When a company buys back its own shares, it reduces the supply of shares in the market. Basic economics, less supply, same demand. Prices go up. We have engineered a structural bid into the market that operates regardless of whether the economy is strong or weak, regardless of whether earnings are growing or shrinking. This is not organic price discovery. This is a manufactured floor. And then there's the Federal Reserve. And this is where I need you to pay very close attention, because this is the part that nobody in mainstream media will explain to you clearly. The Fed has a dual mandate, price stability and maximum employment, but there is an unofficial third mandate that every serious market participant understands. Financial stability. And financial stability means, in practice, that a severe, sustained stock market crash will always trigger a policy response. Always. We have proven this in 1987, in 1998, in 2001, in 2008, in 2020, and in 2022. Every single time the market faces an existential decline, the policy response has been faster, larger, and more aggressive than the time before. Not because the Fed is reckless, but because the modern economy is so deeply interconnected with asset prices, through pension funds, through consumer wealth effects, through bank balance sheets that allowing a true uncontrolled collapse would cause damage that makes the intervention cost look trivial by comparison. So what does this create? It creates what I call a moral hazard spiral. Investors learn correctly that catastrophic downside is limited by policy response, so they take more risk, which inflates asset prices further, which requires even larger interventions when things go wrong, which teaches investors to take even more risk. We have been inside this spiral for 40 years, and every cycle the stakes get higher. Now here's the shocking part, the part I genuinely believe most professional investors are not fully reckoning with. The same forces that prevent a crash also make the eventual reckoning more severe. Think about it through a simple analogy. Imagine a forest where wildfires are suppressed every single time they start. For years, the forest looks lush, it looks healthy, it looks like progress, but underneath on the forest floor, the dry tinder is accumulating. Every prevented fire leaves more fuel for the next one, until eventually, the fire that starts cannot be suppressed. And when it comes, it is not a manageable burn. It is a catastrophe. That is the structure of the global financial system today. The interventions have been so numerous, so large, and so consistent that the underlying imbalances, the debt, the overvaluation, the misallocation of capital have grown to proportions that would have been considered impossible 30 years ago. But, and this is critical, that reckoning is not tomorrow. It is not next quarter. It may not even be this decade, because the people managing the system are not stupid. They are buying time, and they are very, very good at it. Everything I've told you in the last two parts, the machine, the structural bid, the moral hazard, the manufactured floor, it all leads to one question. The only question that actually matters. What do you do with this information? Because knowing that the market is structurally supported is not the same as knowing that you are safe. And knowing that a reckoning is coming eventually is not the same as knowing how to protect yourself from it or how to profit from the period before it arrives. So let me tell you exactly how I think about this. Not as advice. I want to be clear about that. I'm talking about frameworks, about principles, about the way I have been trained through decades of painful mistakes to think about risk and return. In a world where the rules keep changing, the first thing I would do is stop thinking in nominal terms and start thinking in real terms. This is the most important mental shift an investor can make right now. When you look at the stock market and you see it at all-time highs, your instinct is to think it's expensive, it's overvalued, it's going to crash. But that instinct is calibrated to a world with stable money. We do not live in that world anymore. The dollar and virtually every other major currency is being debased, slowly, deliberately, as a policy choice. When governments run trillion-dollar deficits and central banks monetize debt, the purchasing power of money declines. In real terms, adjusted for that decline, asset prices may not be as elevated as they appear. In fact, in many cases, what looks like a market bubble is actually capital fleeing paper money for anything tangible or productive. Stocks, for all their volatility, represent ownership in real businesses, businesses with real assets, real pricing power, real human ingenuity. In an environment of currency debasement, owning equity can be the rational choice, not because the economy is strong, but because the alternative is holding an asset that is being deliberately eroded. This is not what they teach you in school, but it is what history shows repeatedly, clearly, and without exception. The second thing I would do is radically diversify across geographies and asset classes. At Bridgewater, we developed something called the all-weather portfolio, a framework designed not to maximize return, but to survive any economic environment. Rising growth, falling growth, rising inflation, falling inflation. Every scenario has assets that perform well and assets that perform terribly. The goal is to hold enough of each that no single environment destroys you. Right now, I see investors dangerously concentrated in U.S. equities, dangerously concentrated in a single currency, dangerously dependent on the continuation of American economic and political dominance, which, for the first time in my lifetime, I cannot take for granted. The rise of China, the fragmentation of the global order, the weaponization of the dollar in ways that are causing countries to quietly but systematically reduce their dependence on it. These are not fringe concerns. These are structural shifts that are visible in the data, in the capital flows, in the geopolitical decisions being made at the highest levels right now. Gold is not a relic. Commodities are not boring. International markets are not second-rate. They are increasingly essential components of a resilient portfolio in a world where the dominant paradigm is shifting. The third thing, and perhaps the most important, is to understand the difference between a cyclical decline and a paradigm shift. Cyclical declines are normal. They are the forest fires I described. They are painful, they are temporary, and historically, they have been buying opportunities for investors with the liquidity and the psychological fortitude to act. Paradigm shifts are different. They are the moments in history when the underlying rules change, when the reserve currency changes, when the dominant power changes, when the entire framework through which you've been making decisions becomes obsolete. We are approaching one of those moments, not in a month, not in a year, but in a time frame that is shorter than most people are positioned for. And the people who navigate it successfully will not be the ones who had the best stock picks. They will be the ones who understood the system, who saw the machine clearly, who respected its power, who diversified against its failure, and who held their nerve when everyone around them was either euphoric or terrified. The market refuses to crash right now. I've told you why. I've told you how the interventions work, why the incentives align to keep prices elevated, and why the imbalances beneath the surface are growing. But let me leave you with the most important thing I know. The market refusing to crash today is not the same as the market being safe tomorrow. Prepare accordingly. I'm Ray Dalio, and that is how I see it.